right, welcome everybody to the Know It Owls YouTube channel. I am Float Locker. I'm going to go over a quick video on concentrated liquidity and why it's important to have a different mindset than a trader. You see, you can see this chart of Ethereum here, and right here at this price point, you're probably thinking as a liquidity provider, you do not want to be in this market during this price action because price is trending down, right? It went from 4K. Right now it's at 3,000. So what is the incentive for a liquidity provider to be in the market during this time? Well, it's pretty easy to determine, especially coming from a trader's mindset, that traders do not want to be in the market during this volatility, right? Because price is trending down. It's very difficult to time these moves. And more often than not, traders lose money during these periods. Whereas a liquidity provider, especially if you want to actually own the asset long term, it's actually very beneficial. And it's even more beneficial than, say, if you were like even a liquidity provider and say you stayed out of the market, but then you started providing liquidity down here and then the market started moving back up. It's still more beneficial to be a liquidity provider starting from up here, farming all this yield, and then riding the wave back up. And here's why. Because over time you're generating yields on your asset. And since you want to actually own the asset, like say Ethereum in this case, you don't care how far low it goes. As long as the investment is fundamentally sound and you have conviction in that asset, you're fine buying the dip and you're getting paid in yield to buy that dip. And then over time you're taking that yield, parking it aside, and then now you're owning the asset while still having your liquidity and generating more yields. So when it's time for the market to move up, you will get that appreciation back up, right? Now, couple that with managing and minimizing impermanent loss and keeping it very minimal to the point where you can go through this whole sequence here of this drawdown. And when price moves back to your original stake price up here, you're at least break even or close to break even in the liquidity pool value. That's minus the yield. So the yield on top would be just all the profits, right? So as someone that's, say, holding Ethereum and USDC, say they bought it up here, they're sweating bullets through all this drawdown, but they're not earning any yield. They're just sitting and holding the asset. And say price moves back to 4K, they'll be break even, whereas a liquidity provider will be in profit because of the yield, right? So it's very important to understand that it's optional, but it allows you more conviction to actually want to own the asset. And second of all, you want time in the market as a liquidity provider. You don't want to be trying to time the tops and bottoms because it's just much more difficult and you might as well just trade the market, right? Trading the market is fine and it's just another tool in the tool belt. Providing liquidity isn't the end all be all of trading, right? It's just another tool in the tool belt. This part here where Ethereum went to 2K to 4K, trader would have won hands down compared to a liquidity provider. Say you could trade this, now you see the volatility, you jump in for the volatility, generate yields, stack up your yields and your assets, and just wait for the next run in the meantime, right? And then you rinse, repeat, and you have that strategy that just keeps ongoing, compounding, and growing for you. All right. I hope that helps. If you have any questions, please reach out to us and have a nice day.